Hey everyone, welcome back to the channel. Today, we're re-tackling a topic that is going to affect every single one of us, your taxes. Specifically, we're diving into what's being called the tax shock of 2027. Now, I know what you're thinking, taxes are complicated and, let's be honest, a little boring. But stick with me, because understanding this now could save you a serious amount of money down the line. I'm going to break it all down in a super simple way. No confusing jargon, I promise. So, what's this big deal about 2027? Well, a lot of the tax rules we live by today come from a massive piece of legislation called the Tax Cuts and Jobs Act, or TCJA for short. This was passed back in 2017. The TCJA made some huge changes, like lowering income tax rates for most people, nearly doubling the standard deduction, and increasing the child tax credit. For many families and individuals, this meant more money in their pockets each year. Sounds pretty good, right? Here's the catch. Most of these changes for individuals were never meant to be permanent. They were written with a built-in expiration date, the end of 2025. This means that if Congress does absolutely nothing, on January 1st, 2026, our tax laws will automatically revert back to the way they were before 2017, and that's where the tax shock comes in. This isn't some far-off possibility, it's the default outcome if no new laws are passed. Let's talk about what that actually means for your wallet. First, income tax rates would go up. For example, the 12% bracket could jump back to 15%, the 22% bracket to 25%, and the 24% bracket to 28%. That's a noticeable increase for the average person. Second, the standard deduction, which is the amount of income you can earn without paying any tax on it, would be cut almost in half. For a married couple, this would drop from nearly $28,000 back down to around $14,000. This means a much larger portion of your income would suddenly become taxable. But wait, there's more. The child tax credit, a huge help for parents, would be cut from $2,000 per child back to just $1,000. And the cap on state and local tax deductions, known as the SALT deduction, would disappear. While that might sound good, many other itemized deductions that were removed would not come back, creating a really complex and potentially costly situation for many homeowners and high earners in certain states. When you add all of these changes together, higher tax rates, a smaller standard deduction, and reduced credits, the impact is significant. While saying taxes will triple might be an exaggeration for most people, some analyses show that many middle-income families could see their tax bills increase by thousands of dollars a year. It's a huge financial shift that could catch a lot of people completely off guard. So what can we do about it? First, don't panic. The year 2026 is still a little ways off, and this will be a massive topic of debate in Washington. It's very likely that Congress will act in some way to prevent such a drastic overnight change. They could extend some or all of the current tax cuts, or they could come up with a completely new tax plan. The key is to be aware of what's happening. Here's my advice. Start planning now. Talk to a financial advisor or a tax professional about how these potential changes could affect your specific situation. This is a developing story, and you can be sure we'll be following it closely right here on the channel. We'll keep you updated as new information comes out and break down what it means for you. Thanks so much for watching. If you found this helpful, hit that like button and subscribe so you don't miss our next update. See you in the next video.